Hey, wanted to do a quick video for your boy Zach, explaining ESG and how it works. Basically, the same thing that happened to him in the comic industry will happen to any CEO or executive who doesn't fall into line in any industry. And my baby is in the background, so I have to cut this short. But essentially, these people will be personally targeted, their families will be targeted, their friends will be targeted, they will lose their seat. If you want a good example of this, Exxon was forced to sell off some very lucrative assets that they owned due to ESG members who actually made it onto their board, because they essentially, what's going on is these huge pools of money were built up over a couple generations, and the current generation who's inheriting these pools of money never made the money. So to them, it's kind of like free, and so they don't mind if they take a lower return in theory to do something good. So a bunch of hedge funds get access to these huge pools of managed money. And Goldman Sachs on Bloomberg had a great podcast specifically about this, and kind of how this works, that the people who built the money might have built it in real estate or might have built it in media or something, but the people who inherit the money care a lot more about the environment, essentially just because they didn't build it, so it's like free money. But anyways, long story short, a bunch of hedge funds bought a whole bunch of Exxon, and they forced them to sell a bunch of their assets. Not only that, but they forced them to not develop some very lucrative assets that they had. And in exchange for this, Exxon has a much better ESG rating than Tesla. Now, what does this ESG rating do? So the first thing it does is there are trillions of dollars in ESG funds. And the fact that Exxon is in the top 10 of those funds, these are market cap weighted, which means way more money goes to the largest company in that fund than the smallest company. To put this in perspective, Microsoft and Apple, about 13 cents of every dollar you put into the S&P 500 goes into those two companies. So it is significant. So if you think, the top 80 cents of every dollar goes to the top 20 companies in these funds. So it's just this huge constant inflow of money into the stock price, which is extremely valuable for executives, for the CEO, for the shareholders, to be in more funds, as many funds as you can get in. And so these funds, which, I mean, BlackRock has them, Vanguard has them, Fidelity has them, but essentially they're proprietary, and they'll take out companies that don't have a high enough ESG rating. So for example, you mentioned the environment. Tesla used to rank extremely high on these on ESG, and now they are taken out completely because people essentially don't like what Elon tweets. Elon doesn't fall in line, so they do whatever they can to hurt him. Now, this specifically hasn't hurt Tesla, but it hurts other companies for sure, and CEOs get ousted all the time for this. You mentioned that, what happens to the company. It's not the company itself. It's not Anheuser-Busch that might get hurt, but it is the CEO who might get hurt if they lose their ESG rating. So, and you have to remember, a CEO is just a job. You might own Splato Comics, but if you hired someone to manage the company for you and you just kind of were the owner of it, that would be like the CEO. The CEO is just a job. The founders, the shareholders, especially any large shareholders, have a much bigger say in what happens. The board of directors is very, very powerful as well. So anyways, essentially, if you're CEO, you'll get fired. And this has been explicitly stated by Exxon several times, that he has to do these things which don't make sense economically, but if he doesn't play along, then they'll fire him and someone else will come in who will play along. And until shareholders kind of outbid these large pools of capital and get Exxon to do something else, then that's just the way it's going to be. They're going to be doing these things that don't make any environmental sense. Shell also talks a lot about, sorry, that's my baby. Shell also talks a lot about how they invest in project after project after project they expect to never make money on. And if there's an oil project that they are investing in, they expect to make money within 5 years of the investment. So make 100% of the money within 5 years. They never expect to make any money on any of the environmental projects they're working on, simply because they want to maintain their ESG score. So they're just throwing money down the drain. There is a really great, and by the way, oil and gas generally, you cannot get any loans of any kind. So you're wrong that they just go and get a loan from someone else, because it doesn't work like that. Other smaller companies that are maybe willing to give these more risky loans, they will get a bad ESG score if they loan out to oil and gas. So, gas is just, credit is just completely drying up across the oil and gas industry. And Charlie Munger and Warren Buffett, on the most recent earnings meeting they had, the Berkshire annual shareholders meeting, they talk about this. He talks about, Charlie Munger specifically was saying how buying an oil company is like trying to buy yourself a big chunk of cancer. It doesn't make any sense. That they can't really grow. They have a hard time even maintaining, just because even though they're making a ton of money, cash on cash money, it's very, very hard to run a business, especially at that scale, without some kind of loans to kind of bridge. It's called liquidity needs, but essentially, if you have a short-term liability like payroll, but you have something that gets paid back to you every 60 days or something. If you have like a coal shipment, or if you sell like futures which aren't going to be delivered for 2 years or something, sometimes you need just like a little small bridge loan. And these are called these are lines of credit that they use. But yeah, essentially what coal companies have had to do, if you want to check BTU, they essentially have to pay off all their debt because they can't ever refinance. And on top of that, they have literally, they were going to have it, if they decided to pay a very big dividend, but if they didn't, they would have literally had 100% of their share price in cash. And there are other companies like this that just have an extreme amount of cash, like an absurd amount of cash. It's just wild that a company can have 100% of its share price in cash and people still don't want to buy the stock. And that's because I said earlier with these indexes, almost all of the money in the stock market goes into these indexes because people put money into their 401k, put money into their IRAs, their Roth IRAs, and the higher you up on that index, the more money comes in. So if you're not on that index, good luck. You're basically hoping that hedge funds or some other managed money will come in and buy you up. And a lot of these hedge funds, as I said earlier, the money is either currently inherited by people who don't really care about profit and loss as much as they care about, doing something good, or that money will soon transition to those children. So a lot of hedge fund managers understand what time it is and say, hey, you got to jump on the ESG bandwagon, or else you're done for. And by the way, this is also why tech has done so well over the last 10 years, because an ESG fund, essentially they take out mining and gas, like oil, gas, mining, industries that make stuff, anyone who manufactures stuff, they take those out of the index and they just overweight tech. So they buy a ton of Apple, a ton of Microsoft, and essentially that's one of the reasons why tech has been doing so well, because these funds have just gotten massive, and every dollar that goes into these extra funds goes straight to the largest companies in those funds. So Apple just has an enormous amount of buying just from people retiring. Anyways, we're almost at 10 minutes. Those are kind of the incentives. Essentially, what happened to you specifically with Splato Comics, and like imagine you if you need to get a job in the mainstream. It would be impossible. Your opinions have completely destroyed any chance you've had working in the mainstream. And yes, you've gone and done it yourself. Imagine a CEO of a coal company or of an oil company. Like, do you think they're gonna go and start a whole new oil company all by themselves, especially with no credit? It's never gonna happen. So you have people who've been working in these fields for, so one company I follow is Occidental. Vicky has been working in oil fields for like 40 years, 50 years. And you think she's gonna just go and start a new oil company and try and compete for rights, and especially because she doesn't have any, she's not gonna be able to raise any money through credit or anything like that. But she's an amazing CEO. So what does she do? She has to fund these billion-dollar projects, which may never pay anything back, and certainly don't pay anything back right now, just to get her ESG rating up. And it's just something you have to deal with in the oil and gas industry. Anyways, this is already kind of 10 minutes. If you have any questions, please let me know. I just wanted to throw this out there real quick because, like, ESG is very real. It would be like someone saying in comics, like, oh, no, people aren't forced to hide their political opinions. Everyone can say anything they want. Look at these people in Comicsgate. They are free to say whatever. It's like, yes, but you're getting harassed every day. People lost their jobs over it. Everyone who's in the industry is terrified of losing their job in the industry. Anyways, that's my baby, so I've got to go. Have a good one. If you have any questions, please let me know. I don't mind explaining this. It does get very dense. And if you are not if you're not into finance, and you know, like it's gonna take more than a couple hours. Like, sorry, like it's like trying to teach someone how to make a comic book in 2 hours, and then someone being surprised when it doesn't work. All right, bye.